The dot-com bubble wasn't just about irrational exuberance or stupid investors throwing money at business plans scribbled on napkins. Although there was plenty of that, it was fundamentally a story about how cheap money combined with technological change and human psychology to create one of history's most spectacular misallocations of capital, destroying trillions of dollars in wealth, bankrupting thousands of companies, and yet somehow still managing to build much of the internet infrastructure we rely on today. And to understand how this happened, how smart people convinced themselves that the old rules of business didn't apply, how companies with no revenue were valued in the billions, how an entire generation of entrepreneurs and investors went temporarily insane and then crashed back to reality, we need to start not with the internet, but with money itself. With the Federal Reserve's decision in the mid-1990s to keep interest rates low despite a booming economy, creating an ocean of cheap capital desperately seeking returns. And that capital, combined with genuine technological revolution and the human tendency to extrapolate recent trends infinitely into the future, would inflate a bubble so large that its popping would be heard around the world. The stage was set in the early 1990s when the internet transitioned from a military and academic network to something approaching a commercial medium. The World Wide Web was invented in 1989, but didn't gain traction until the Mosaic browser made it accessible to normal people in 1993. And suddenly you could click on hyperlinks and see images and navigate through this weird new space that seemed to contain infinite possibility. Early adopters recognized immediately that this was transformative. That if everyone was going to be connected through this network, if information could flow instantly and freely, if transactions could happen without geographic constraints, then the entire structure of commerce and communication would be revolutionized. And they weren't wrong about this. The internet did transform everything. But the path from recognizing the potential to realizing it profitably turned out to be far more complex and expensive and littered with failure than anyone anticipated. In those heady early days, the Federal Reserve under Alan Greenspan had cut interest rates in the early 1990s to fight the recession that followed the savings and loan crisis and the first Gulf War. And as the economy recovered, the question was when to raise rates to prevent inflation. But inflation remained mysteriously subdued despite strong growth. Greenspan theorized that productivity gains from information technology were allowing the economy to grow faster without inflation than traditional models suggested. So he kept rates low. The federal funds rate stayed around 3% through much of 1993 to 94, then rose to 6% by 1995, but then fell back to 5.25% by 1996 and stayed in that range through 1998. These weren't dramatically low rates by historical standards, but they were low relative to the strength of the economy and the profits being generated. And this created a problem for investors. If you could only get 5 or 6% on safe investments like treasury bonds, and the stock market was already expensive by historical measures, where could you put your money to get the returns that pension funds and endowments and wealthy individuals expected? And the answer that emerged was technology, specifically internet companies that promised exponential growth. Because if a company could grow at 100% or 200% a year, even for just a few years, then current valuations didn't matter. You'd make fantastic returns, and cheap money made it easy to chase these returns. Venture capital funds raised enormous amounts. Corporations created venture arms. Individual investors opened online brokerage accounts. And all this money went looking for the next Microsoft, the next Intel, the next company that would dominate the digital future. The Netscape IPO in August 1995 was the moment when internet fever really took hold. Netscape made the browser that most people use to access the web. They had revenue, but no profits. They were competing with Microsoft, which was giving away its browser for free. But when they went public, the stock doubled on the first day, valuing the company at nearly $3 billion. And this sent a signal that internet companies could command absurd valuations based purely on potential, not on actual earnings or even plausible path to earnings, just on the story of internet domination. And suddenly, every entrepreneur was pitching an internet business. Every venture capitalist was looking for internet deals. Every investment bank wanted to take internet companies public because the returns were so spectacular and the demand seemed insatiable. Retail investors who had missed Netscape wanted in on the next one, institutional investors needed exposure to technology to keep up with benchmarks. And the media created celebrities out of entrepreneurs and analysts and anyone who could tell a compelling story about the digital future. The business model, to the extent there was one, was straightforward in theory but catastrophic in practice. You would build a website offering some service or product. You would spend enormous amounts on marketing and customer acquisition to gain market share and establish your brand. You would lose money on every transaction or even give away your service for free. But eventually you would achieve network effects and economies of scale that would allow you to monetize your huge user base. And then you would be fabulously profitable. This was called Get Big Fast. And it made a certain kind of sense if you believed that internet markets would be winner-take-all, that network effects were so strong that the first company to dominate a category would be unassailable, and therefore the rational strategy was to sacrifice short-term profits for long-term dominance. The problem was that almost every internet company was pursuing the same strategy simultaneously, creating a race to spend money as fast as possible, and the monetization part, the actual turning of users into profits, remained perpetually in the future, something that would happen once you achieved sufficient scale, except scale kept increasing and profits never materialized because the fundamental economics of most internet businesses were terrible. Amazon is instructive here because it's one of the few .com companies that actually survived and ultimately validated the Get Big Fast strategy. But even Amazon took years to become profitable. Jeff Bezos launched it in 1995 selling books online, took it public in 1997, and spent the next several years losing hundreds of millions of dollars as he expanded into new categories and built infrastructure. The stock was incredibly volatile, soaring above $100 per share in 1999, then crashing to single digits in 2001. And at multiple points the company seemed like it might go bankrupt. Analysts called it Amazon.toast. But Bezos had genuinely thought through the economics, had understood that books were a good category to start with because they were standardized and shippable and had enormous selection that physical stores couldn't match. And he methodically built the logistics and technology infrastructure that would eventually allow profitability, and crucially, Amazon survived long enough to reach that profitability. But for every Amazon, there were dozens of companies pursuing the same growth-at-any-cost strategy without the underlying economics to ever make it work. Pets.com spending millions on Super Bowl ads to sell pet food at a loss. Webin building massive infrastructure to deliver groceries with no clear path to profitability. Cosimo.com offering free 1-hour delivery of essentially anything. These companies weren't just losing money, they were burning through capital at rates that should have been recognized as unsustainable, but cheap money and the fear of missing the next Amazon kept investors funding them. The venture capital model, which had worked well in previous technology waves, became distorted by the flood of capital. Traditionally, VCs would fund a small number of companies, work closely with them, and understand that most would fail but the winners would more than compensate. But in the late 1990s, VCs raised enormous funds and needed to deploy that capital. So they funded far more companies than they could adequately support, and they funded them at higher and higher valuations, because if you didn't match the valuation another VC was offering, you'd lose the deal. This created perverse incentives where companies were rewarded for spending money. If you raised $50 million at a $200 million valuation, then raised another $100 million at a $500 million valuation 6 months later, that was considered success even if you'd accomplished nothing except spending the first $50 million. And founders learned to play this game, hiring aggressively, leasing expensive office space, spending on marketing, not to build sustainable businesses, but to create the metrics that would justify the next funding round at a higher valuation. Because as long as capital was available, you could keep the game going. And if you timed it right, you could take the company public and let public market investors hold the bag. The investment banks facilitated this madness through IPOs that were obviously mispriced. Companies would go public with first-day pops of 100% or 200%, which sounds great, but actually means the company sold shares far too cheaply, leaving money on the table that should have gone to the company. But the banks liked these pops because they created excitement and made investors feel like IPO allocations were golden tickets. So they deliberately underpriced offerings, knowing the stock would soar on the first day, and this created more demand for the next IPO. It was a perpetual hype machine where banks made fees, Early investors and insiders made fortunes selling into the IPO pop, and retail investors who bought at the inflated post-IPO price often got crushed when reality set in. But there were enough winners, enough stocks that kept soaring even after ridiculous IPO pops, that people believed they could get rich just by getting access to IPOs or buying on the first day and flipping. It was speculation pure and simple, but speculation dressed up in the language of investing in transformative technology. The media played a crucial enabling role. Business news networks like CNBC became cheerleaders for the bubble, featuring entrepreneurs and analysts who talked about paradigm shifts and new metrics and how old valuation methods didn't apply. Traditional measures like price-to-earnings ratios were dismissed as irrelevant because internet companies had no earnings, so analysts invented new metrics: price-to-sales, price-to-eyeballs, price-to-clicks, anything to justify valuations that would have been laughable under traditional analysis. And these weren't stupid people, they were smart analysts from prestigious firms, but they were caught up in the zeitgeist, genuinely believing or at least convincing themselves that the internet changed everything. That losses didn't matter if you were gaining market share, that profitability was a quaint concern for old economy companies. And the media amplified these messages because bubble coverage was good for ratings. People wanted to hear about 25-year-old millionaires and ordinary investors getting rich day trading, not boring warnings about valuations and fundamentals. So we got a constant stream of hype, of IPO countdowns and stock tickers scrolling across screens and analysts upgrading stocks that had already quintupled, creating a feedback loop where media attention drove investor interest, which drove stock prices, which created more media attention. The retail investor participation was unprecedented. Online brokerages like E-Trade and Ameritrade made it trivial to trade stocks with low commissions. People who had never invested before opened accounts and started day trading. There were stories of secretaries and teachers and retirees making six figures trading internet stocks, quitting their jobs to trade full-time. The NASDAQ Composite Index, heavy with technology stocks, went from around 1,000 in 1995 to over 5,000 by March 2000, quintupling in 5 years, and individual stocks did far better. Companies that went public at $15 would trade at $150 within months. And while sophisticated investors understood these were bubbles, the momentum was so strong that even skeptics got pulled in, because being right too early meant watching everyone else get rich while you sat on the sidelines. And eventually the fear of missing out overpowered risk management. There's a famous story about Julian Robertson closing his Tiger fund in 2000 after losing billions by betting against overvalued technology stocks. He was right about valuations but wrong about timing, and he capitulated just before the bubble burst. This was the environment where being rational and cautious meant losing money and looking foolish, while being reckless and momentum following meant getting rich, at least until the music stopped. The cheap money underlying all of this wasn't just low interest rates. It was the enormous amounts of capital flowing into venture funds and then into startups. In 1995, venture capital funds raised about $7 billion. By 2000, they raised over $100 billion, a 15-fold increase in 5 years, and this capital had to be deployed. VCs are compensated based on assets under management and on returns, but returns require investing the money first. So there was pressure to do deals, to fund companies, even when the opportunities weren't that compelling. And once you've invested in a company, you're incentivized to help it raise more capital at higher valuations, because that makes your investment look good on paper, creates unrealized gains that you can show to your limited partners, justifies raising even bigger funds next time. So the system was designed to inflate valuations and ignore warning signs. And the companies receiving this capital responded rationally to the incentives. They spent it as fast as they could, because if you didn't spend it, you weren't being aggressive enough, you weren't getting big fast, you'd lose to competitors who were willing to burn more cash to gain market share. So we got a race to the bottom in terms of financial discipline. Companies competing to see who could light money on fire fastest, Super Bowl ads for companies nobody had heard of, billion-dollar marketing budgets, free shipping, huge customer acquisition costs, all justified by growth metrics that ignored the fact that most customers were being acquired at a loss and would never generate enough profit to recover that acquisition cost. The international dimension accelerated the bubble. Money flowed from around the world into Silicon Valley and other tech hubs, Foreign investors wanted exposure to the internet revolution. American investment banks took .com roadshows to Europe and Asia, and suddenly you had pension funds from Norway and insurance companies from Japan investing in companies they didn't understand based on presentations promising exponential growth. And this worked both ways. American investors funded internet companies in Europe and Asia, often carbon copies of American models, Amazon of Germany, eBay of China. These companies would replicate whatever was working in the US and promise similar results. And they'd get funded at valuations that reflected US bubble prices even though their markets were smaller and less developed. So the bubble became global, creating an international race to see who could create the most valuable internet economy. And of course, this was unsustainable. Most countries couldn't support dozens of well-funded internet companies. But as long as capital was flowing, nobody wanted to be the one to say the emperor had no clothes. The peak came in March 2000 when the NASDAQ hit 5,048, and it's hard to identify exactly what triggered the reversal. There was no single dramatic event like a bank failure or policy change. Instead, it was more like a gradual recognition that this couldn't continue, that companies burning through cash at incredible rates would eventually run out of money, that the promised profitability kept receding into the future, that maybe the internet, while transformative, wouldn't make every internet company fabulously valuable, and once selling started, it fed on itself. Stocks that had gone up on momentum came down on momentum, margin calls forced selling, mutual funds that had gorged on technology stocks had to sell to meet redemptions, and the decline accelerated. By October 2002, the NASDAQ had fallen to 1,114, down 78% from the peak. Trillions in market value evaporated, thousands of companies went bankrupt, hundreds of thousands of jobs were lost, and the survivors, companies like Amazon and eBay and Google, were trading at fractions of their bubble highs even though they were the actual success stories. The human toll was significant, not just wealthy investors losing paper gains, but employees who had been paid partly in stock options that became worthless, who had taken jobs at startups thinking they'd get rich, only to face layoffs when the money ran out. People who had bought houses based on inflated stock portfolios and now faced foreclosure. Retirees who had moved savings into technology stocks at the peak and lost their nest eggs. And while nobody should have much sympathy for day traders who quit their jobs to speculate and lost, there were plenty of ordinary people caught up in the bubble who had just followed conventional wisdom about investing in growth and technology and being optimistic about the future. And they paid the price for a systemic failure that was much larger than any individual's decisions. The cheap money created an environment where rational individual choices get exposure to technology, diversify into growth stocks, take advantage of stock options, added up to collective madness. The aftermath saw a wave of recrimination and analysis, congressional hearings about analyst conflicts of interest, accounting scandals like Enron and WorldCom that revealed how companies had been inflating numbers, prosecutions of executives who had cashed out at the peak while telling employees to hold, reforms like Sarbanes-Oxley that tried to improve corporate governance and financial reporting. But these addressed symptoms more than causes. The fundamental cause was too much money chasing, too few good ideas, and that came from monetary policy that kept capital cheap even as asset prices inflated, from a financial system that rewarded speculation over prudence, from human psychology that will always tend toward bubbles when conditions permit, and from the genuine difficulty of valuing transformative technology, because the internet really was revolutionary. It really did justify significant investment, but distinguishing between companies that would thrive and those that would fail was nearly impossible in real time, and cheap money meant you didn't have to distinguish. You could fund everything and assume the winners would compensate for the losers. Except when everyone follows that strategy simultaneously, you get overcapacity and brutal competition that destroys value even in the winning companies.